Okay, recording has started, and it is, I can't believe that. It's amazing how time flies. It's April 25th already. And this is the Live Edge demo discussion. I'm Tim Quast. With me is Brian Wilson. We're going to tag team this, and I'm going to go first, which probably is a disadvantage to Brian, but then you get the good capstone because he's brief, I'm long-winded. But I've got several things to cover, and so does Brian. And I want to help you use the platform to good effect. We always share the things that we're doing. So I want to talk about what we describe to you because it's helpful to understand how the platform works. And repetition is the best form of emphasis. Repetition is also boring, so we don't want to do too much of it. But I do want to point these things out because they're evidence that the data are very reliable. And here's what I mean. What I want to back up and tell you why we were unsurprised by basically anything in the last couple of weeks that has happened in the market. So I'm starting here with broad sentiment because we say there are three things. Every day, look at broad sentiment. What's the supply-demand balance in the market? Because that reflects BlackRock, Vanguard, and State Street. I'm just using that as an example. But what big institutional money does, that everybody talks about that, but it's passive money. Passive money needs large, liquid, low volatility securities that are the benchmark. If there is volatility, then it becomes a problem for them, particularly if stocks move a lot. That creates tracking errors for indexes, and we're going to know when those conditions exist. Then context. Context, is in part these green squares, options expirations. It can also be things like GDP out today, and I'll talk about that in just a moment. But these are all things that we point out. And then there are divergences. We actually are starting to develop a divergence. If you look at the supply side, it's falling. It's still above 50%, and maybe it rises. I don't know what it's going to do. We just check it every day. And it looks like the demand side, depending on what happens, I don't know, it's close to a bottom. But here's the thing. We knew that demand was falling into options expirations and supply was rising. So we could say, look, this could mean that the market falls. And it did, we don't know exactly what's going to happen. There is a central tendency. But why this happens is that if back here, there was a lot of buying of derivatives, and then prices deteriorate into the point where you might make use of those, then everybody lets those go. And of course, most options expire unexercised anyway. But all that implied demand goes away and the market declines. Now, the flip side of that is, as the market got to this green line, you see this green line, it's just 4.0. We have found statistically that it indicates a point where models are likely to reverse direction. They'll be underweight and they'll reweight. But if it's at options expirations, it could be something else. I'll explain. And sure enough, right, just clockwork, drops below 4, and we hit options expirations the following Monday. So this Monday, new options traded. All the underlying securities have been discounted. You can get very good prices for those options now. And clearly that happened. Supply began to reverse. People bought these options. The market rushed up because that's implied demand returning. So the underlying rises in price. Then on Tuesday, we call it Counterparty Tuesday, the banks that make markets and all those things, there are supermarkets out there like Goldman Sachs and JP Morgan and Morgan Stanley that make a lot of that liquidity available. Well, if they don't have enough of the underlying asset, they've got to go buy it. And if they've lost money in the process of buying and selling options, they may have to sell something to compensate for the value at risk. But that gave us 2 good days. And, I wrote on Wednesday, that's probably the end of it, but those things occurred exactly as one would expect if the cause is options. And sure enough, Wednesday, our gains died. So that gives you a pretty good view of what may happen. And then you have hanging out there, did the banks lose money? Well, if they do, then they have to sell something. shore up capital a little bit. So then you have a bad a data point like the GDP. I don't know how you miss by 50%. So if you expect 2.4% and it comes in at 1.6%, that's not a 30% miss, it's a 50% miss. If we were 50% wrong, we would have useless analytics because you might as well just flip a coin. Anyway, I just find it amazing how those figures can be so wrong, and yet we continue to give credence to the people who produce them. Anyway, we had warned, look, it takes one bad data point to crumble the market, particularly if the big banks have to sell some assets. So that then leads to today. And you say, well, why then is the market recovering? And that will lead into, I'm going to tell you a bit about trading the broad market as opposed to individual securities. Generally, you could look at the market and say, well, it's unlikely to remain down. I don't know what's going to happen from day to day. I just know the central tendency. So, and during earnings season, we're in earnings season. And it's more difficult to trade stocks. You could have a stock with great supply-demand balance, and it's not, it's reporting earnings a week or two from now, but a peer reports results this week and declines 15%. Well, it's probably going to pull your stock down too. I mean, it has an effect on probabilities because machines and the market makers for baskets of securities associated with ETFs treat things similarly, treat things like a herd. And so it can create additional risk. Happened to me. I should have been it's my own fault, not the data's fault. We were heading into earnings and options expirations, and I had SentinelOne and Palo Alto Networks, a customer of ours over on the corporate side, reported results, lost a third of its value, and I got hammered. I got half of it back, but that's my own fault. So you have to be aware of those risks. So I prefer during earnings season to trade the broad market based on these indicators. So I look at the data here and say, well, demand is below the entry point. It's leveling off. Supply has come down, and the market is way down. What is the probability that it gets at least half of what it gives up back? Well, mathematically very high. Why? Because I know what the supply-demand balance is. Demand isn't great, but it's again near a bottom. Wouldn't take much if the market is down all of its volatility, call it 1% or more, because the broad measures, that's a pretty big move. Well, pretty high. So I bought SPXL this morning. And that, how do I know? You'd say, well, that seems like a crazy thing to do. If the market's down hundreds of points, the Dow, why would you do that? Well, here's why. I know what the data are. I know what the probability is. I know we're out of the expirations period. All that stuff's behind us. It's not going to impact things. Earnings now take a back seat to broad market considerations. And sure enough, worked great. The only trouble was I had to step away for a little bit, and I put a stop and limit in, and I got stopped out. And that's why I hate that. I don't care what the broker dealers tell us. When you put in a limit order, the order has been sold. And it may be hidden, but there are machines that are going to find that. And sure enough, took my order out and went right to my limit, to the penny. So just beware of that. That was a little disappointing, but it was a correct read on the data. And I currently have a trade. It may not work. I don't know what's going to happen. But I looked at, I thought, well, let's go look at big tech, which was way down and really recovered. Well, I look at big tech and go, oh, there's a terrible demand side, and look at the supply side. It's rising. This is terrible. Brian Wilson wrote about this. Big tech's the leader. So before this meeting, I bought SQQQ. Is that a gamble? Well, it's a statistical gamble. I'm using probabilities. And I'm not going to keep that trade, and I might close that trade out and buy SPXL again. I might, because I know the data are pretty good. I'll look at where we are into the last half hour. But here's the thing. I am not guessing. That's important. The decisions I'm making for these, and I'm not advocating leveraged ETFs, but they are if you understand the market structure and the probabilities and the supply-demand balances and how the market moves, broad measures 1%, underlying securities 2%, anything that's momentum, so that's QQQ 3%, just a general rule. that if things are way to one side or the other, the probability, if I know the supply demand balance of producing a return long or short, is very high. Look, that's what high frequency traders are doing. We're just not using the same time frame that they do. So that to me is a much more comfortable low risk trade, believe it or not, than trying to trade individual securities during earnings season when I don't know what they're going to do. Now, having said that, I want to give you one final thing here. Then Brian and I will collaborate on the big items, what's next. But let's look at daily trading ideas. Nothing in momentum, nothing makes the cut. Look, it's very, and is it right? It told us this several days in advance. Look, don't trade momentum because you'd get killed. Well, it's very helpful to know that a data set is warning you away from doing those things. If you click on low volatility, now there are a number in here. There are 11 in here. And if I just sort by probability, there's JCI, Johnson Controls. So I could look at this and say, can I buy this in this range? And I actually tried pre-market, and I could not get a fill. It's very difficult in individual securities. You can trade pre-market on Interactive Brokers in leveraged ETFs that are very liquid. It's possible to buy and sell those things outside market hours. I don't believe there's a particular advantage. I think you're more likely to get sucker punched outside of regular market hours. At least during market hours, it's like it's a refereed game. It's a stacked game. Machines have better information and more speed. They know more. So it's not a fair enterprise, but if our time frame is longer, we'll know. And even today, you could have gotten your 1%, 80, 90 basis points, 1% in JCI, even under these conditions. It dropped below 64, dropped below the entry point, but say you're around 64, and that means you got to get out around 64, call it 55, 60, thereabouts. Well, you could have done that today, just in a single day on a terrible trading day, just using the probabilities. So it's just an example. Now, again, I favor market trades over individual securities during earnings season. The rest of the time, I favor individual securities, but just something to know. Okay, so those are the principal points I wanted to cover, and we can talk about the broad market. I'll join you for that, Brian. So I'm going to stop sharing, and I will turn the floor to you.
Sure. Quick question for you, Tim. Do you mind repeating your 1, 2, 3 rule for everyone in case someone didn't get that?
Right. So here it's a basic principle, and everything we talk about are central tendencies. They're not absolutes, but the 1, 2, 3 is that the broad measures, the benchmarks, let's call them the Dow, the S&P 500, even the NASDAQ 100, although it's a little bit more because those stocks tend to be more volatile, move 1%. ETFs that are associated with baskets of stocks tend to move 1%. Steve, and I'll cue you, Steve, to ask your question. Then the underlying securities, we measure this stuff. You can too. You can run a portfolio and look at the average volatility, dump it into Excel, run a computation, run an average. You'll see it. Stocks average, even the big liquid stocks average 2.2, 2.5% volatility. So they move twice as much as the benchmark. And you say, well, how could that be possible? If the benchmark is comprised of the underlying stocks, how does it have half the volatility of the stuff that it's supposed to track? Because it uses a sample. It wants very low volatility stuff because why? Index funds cannot have tracking errors of more than 2% or they get in trouble. Regulators will say, look, you say in your prospectus you do this and you're not doing it. You can get in trouble, get fined. Plus, tracking errors cause the fund distributors who provide products through wholesalers to stop selling the product. So two stocks underneath move 2%. We use that to our advantage, right? If something's down 1%, 1.5% versus its price, its previous closing price, we have a very good opportunity to make money. Then momentum tends to move 3%. Why? I don't know. It's the way the machines work. So if we can take 2% of that, we have a very high probability capacity to produce a return with limited risk. That's what we're after. Everybody talks about the stocks that can post 100% return. Well, you can give up 70% of it too, just like that. It's much better to take 1 or 2% in high probability conditions and do that over and over. It's what high frequency traders do. It's what Renaissance Technologies does. And that is a much better way to produce returns and keep your blood pressure under control. Okay, what's the order? Steve, go ahead, please.
Yes, you were talking about on your limit orders that they'll come down and swoop in on you. What about, I thought that if you were buying 99 shares, not over 99 shares, that you were off register for this kind of action.
To buy, I
right?
do that. No, I often buy at the market. I do, often do. Why would I wait for somebody else's price? I'll take, if the spread's thin. What I'm talking about is if I walk away and I've got a position, then I'm putting in a stop and a limit, and I hate doing it. But that's what happened to me today.
But if you're buying 99 shares, who are the people who are seeing you to come in and swoop in on that?
What I mean is, so I had a stop on my whole position, so I put a stop on my position in SPXL, and I think I own 250 shares of it. So that,
okay.
Call that $40,000 worth. And I put in so it was trading around, call it 1680. I put in a stop around 16, because I got in a good price. So that around 1652, and went to run an errand. And I put my limit out at 1788. And I came back and I've been stopped out. And where did the price go? 1788. So
now if you'd have bought 399 or 299s and a 40, whatever it was, to match your 250, would you have got stopped out?
Well, once I put in a stop, I have ceded the order to the market.
Hello?
Yeah. So then it doesn't matter. What Steve's talking about is I oftentimes will buy stocks that maybe have, it depends on what's at the bid and the offer. So let's say it's Johnson Controls and there are 100 shares at the bid and the offer. That's it. If I buy, but there's a 1 penny spread. So I might as well, I think, can you just, if you would mute yourself during the conversation, it'd be very helpful. I agree. I think they do see, they not really see it, JC, but they know where the prices are ranged.
Not from what I've been told by people that work there.
I know, they tell me the same thing. I had this conversation with Doug Sifu at Virtu, and he said, and I asked Interactive Brokers. I had this discussion with him. I gave him an examples. I said, okay, let me see if we can mute. There we go. Okay, so I agree with you, John, that they say that doesn't happen. I don't think it's that they show the order that they get in trouble for that. But those orders go into a pipeline, and the people who buy them know that they're going to pay a certain price, and they have to have a way to produce a return on that, because it's payment for order flow.
That's my point, right?
Yeah,
exactly. So I'm pretty sure I'm almost a 99% probability that they know where those orders are. I mean, it happens to me too. Like it happened to me I think 2 days ago in the futures market. Like they just see the stuff and they go get it.
Right. I had an interchange with Interactive Brokers, and I said, the price didn't even move on my screen and I got stopped out. And he said, so I had to add I bought a few more data feeds actually. He said, no, you're probably right. The price never changed because all of that action occurred away from the prices you're actually seeing. And this is the problem. Citadel buys all the proprietary data feeds. So you and I, we retail traders, we are going to get effectively what's called the SIP, the Securities Information Processor feed. It's slower by 100 milliseconds, 30 milliseconds than the feeds that the exchanges are selling to Citadel. So Citadel knows the price is moving before you do. And that's the problem. So that's why I hate, if you have to protect yourself. You have to have a certain risk tolerance. And if it goes down 50 basis points, I'm throwing in the towel because I don't want to take the risk that it goes down 100 basis points, right? But realize that if you're watching it, there is no advantage. If you're watching your order, there is no advantage to putting in a stop or a limit. You can just enter, if it's a leveraged ETF, like I bought SQQQ. It's got 1,000,000 shares at the bid and the offer. I'm going to buy 1,500 shares or something like that, 3,000 shares. So I'll just buy it at the market, right? And sell it at the market. I'm going to get the best price, maybe even a little improvement. So why would I put in a limit order? Why would I reveal what I'm willing to take or pay to someone else, which is what you do when you put in stops and limits. So, Brian, I'm chewing up your time. Sorry.
Sure. No, you're fine. Great discussion points. I wanted to provide a couple of examples just in terms of daily trading, and one trade was a decent trade for me. One didn't work, and hopefully we can learn together in the process. I'll start with one of them that did not work for me, which was Amazon a couple of days ago. And I'll show you where I got in and where I should have gotten out. So I got into the trade on the 18th. Amazon had been under pressure. Sentiment was steady, right there at the 6th level. Short volumes had been coming down. Could short volumes have been a little bit lower? Sure, but I was willing to step into that trade. Now, where I messed up is the fact that sentiment started to decline, and I stayed in the trade. And even a couple of days ago, I got in here. I was roughly even on my trade, but I wanted to make money. I was a little greedy. I should have gotten out there. Sentiment continued to slide, and then I'm getting out today. So Amazon, I made a mistake. I made a mistake in terms of when sentiment started to slide. I should have just gotten out of that trade instead of holding on to it. Here's another one recently which did work for me. NVIDIA. And this one was a good market structure lesson in terms of context. So what we were tracking was sentiment that was rising, good sentiment moving higher. NVIDIA came under heavy pressure into options expirations last week. I think it was 10% down last Friday, if I remember correctly. Heavy pressure. I looked at the setup at the end of the day, short volumes going lower, sentiment moving higher. I'm like, I'm buying that. And, sure enough, come Monday morning, I was able to, make a nice profit on that. So just two different trades. One, I didn't do as good on, but, one, the setup favored me. I knew I was coming out of expirations. It was a good setup for potential gains, and it did work out. So I just wanted to share some, actual lessons going on there. I mentioned this last week. I did a review, and it's worthy, I think, of just sharing with everyone. What I did is this is data from December 2017 to June of last year. I need to update the data. But what I looked at is what are the cumulative returns at different sentiment levels? And we don't get below 5 very often. If you look at the last few months from a broad market perspective, we stayed north of 5, seemingly forever. And market gains were, tremendous during that time frame. So when we get below 5, what should we expect? Well, we moved below 5, last week during expirations. There's the cumulative return when we get below 5, between 4 and 5, negative 2.6%. We saw that last week. When we get down to 3, between 3 and 4, we're in that area right now, 5% advances. So once again, you get below that oversold conditions and the market tends to bounce. Now, what happens if you have a really rough stretch and the market really falls apart? Well, it gets really ugly. That's where a lot of the losses come into play, and you can be down, almost 14% total returns between 2 and 3, and between 1 and 2, it very, very rarely gets there, but 90 basis point returns. So that's kind of where we're at. And, once again, we're in the 3s right now. They're at 3.2. Tim had mentioned, and I mentioned it in my note this morning, we're waiting for leadership from tech. And we'll see this on our big tech portfolio. There's just nothing going on right now. You look at what's happening there. Sentiment is just very, very weak at 2.5. Short volumes are going the other direction. We really need leadership from tech for any type of rally to stick. So kind of watching to see what happens there. I mentioned this morning. It's worthy of showing you the visual of what I was talking about. This has only happened a couple of times during the last year. And what I'm referencing is SPY going below neutral. So you can basically think of SPY representing the market. And for all intents and purposes, we're always at neutral. You can see that back in latter part of September, we went below neutral. Latter part of October, we went below neutral. And this is the first time that it's occurred since then. And during this stretch here, and I'll show you one other visual here in a second, what occurred for this stretch is the market rolled over. Part of the reason that that occurred is that short volumes across the market stayed high. Actually, short volumes for SPY stayed high as well. The next time, look at this tremendous surge all the way up to 10, and the market just takes off like a rocket ship. Now, let me show you, and Tim mentioned this a couple of days ago. It was a great point in terms of, what will it be this time? Will it be A or will it be B? And what he was referencing in that note is, once again, sentiment moving below neutral. Back in, this was actually going back to August. This is the one in October, I guess. But sentiment going below neutral. Look at short volumes staying high. What happens to the market? It continues to roll over. We get to the end of October. Once again, sentiment goes below the oversold conditions, and look at what happens there. There's the difference. One period you have very high short volumes. One period you have very low short volumes. What will happen this time? To be determined. We're not quite there yet in terms of being able to see what happens, but you can see what has occurred the last couple of times that we have been there. And Tim, part of that discussion is kind of covering what's next. I think what's next in terms of my vantage point is I'm looking for short covering, and I'm looking for leadership from big tech. That's two of the things that I'll be watching. From a context perspective, we do have let's see, is it PC? I forget which one's coming out tomorrow. PCE tomorrow, and then we have month end window dressing coming up and portfolio adjustments. So that's kind of the next things from a context perspective.
Yeah, that's really good. I would add to it that these times where the supply demand equation breaks down like it has, and I'm going to follow your lead here, Brian, and do this. Going back to that same view, it's interesting that if you back up and look at the whole data set and these periods where we have entry points or weakness in SPY, SPY is not a good predictor of what's going to come. This is. Broad sentiment is a very good short-term predictive tool. But when the demand deteriorates in SPY, it tends to last from a month to a quarter. I'm not saying that's going to happen this time. You look at this period, it was basically the better part of a quarter where we had trouble in the markets. And if you backed up longer term, you'd see the same thing. I won't do it here for time. But if you look at SPY and you do that, you back it up and look over the long term, let's just say we look back 3 years, the periods where you have what's developing here, it tends to run a while. I mean, it's not a short-term event. This is, in 2022, it's really tough. There were repeated periods where we had those kinds of deteriorations, and we don't have enough data yet to know. What we do know is that what has been happening, we talked about that for a long time. We said what has been happening is ending. And you could see that in the data. You could see it in the long time that broad market sentiment spent at 6. Maybe I'll go to that really quickly here. So if you back up just to a 90 trading day view, you can see this. The data, the broad market spent a long time at 6. Well, it's the end of a momentum market. That momentum was created by what happened at the end of October. We had an entry point in the market, and the Fed changed its monetary policy. So we're not going to hike rates anymore. Probably the next thing we do is cut rates, and then all the money rushed back into the market, and that created momentum in a very long arc. And and so that's what pushed the demand or market structure sentiment up above the red line. Then we spent this long time right at the red line. That's the end of a cycle. Now a new cycle will begin. I don't know what it's going to be. We'll just take the data as it comes. Now, that's the beautiful thing. We don't have to know or worry about what's coming. We know what is occurring. And we have good context for what that means. We know whether to go long or short the market. We just keep our time frames short. But I would expect, if history is a guide, that there will be more to this. We might have a nice recovery, might falter again. It will depend, as Brian said, heavily on what happens on the supply side. If the supply stops falling here, I'd be concerned. Right? If it does what happened here, this was a big market short at the March expirations that produced what happened into the expirations period. Do we see all this covering again? If we do, we're fine, and we can, we'll probably have momentum opportunities to trade again. If we don't, we're not going to have those opportunities. And so, when I think about what's next, that's what we look at. We just always look at broad sentiment, the context, and divergences. And it's just vastly superior to trying to look at charts and figure out what those mean, because they don't reflect underlying supply-demand changes. And this does. And so it's difficult for us all to get caught out when we know what the supply-demand equation is. Really, the only time it's ever happened to me is when I don't pay attention to the data. It's not that the data is perfect, but it's much better than guessing. That's all I've got. Okay. Words of wisdom? Yes, John, please.
So, what do you think would push supply back up other than people getting short? And my sense is they aren't, because, when we tend, 2022 was rates, right? Like I've looked at that BS data going all the way back to 2012 by year. And prior to that, like we really never had, every time we had a rate shock, that's kind of when we got a dip, but like minus that, that's what it is. So unless we kind of get above 470 here in the 10-year, we're flirting, right? I could see us doing that, but it feels like everyone kind of got short up there and took off here. I don't know. Is there anything in the market that would say that people are going to, short volume will go up because they're putting on shorts, or, what is it, do you think?
Well, I think macroeconomically, if the economic data deteriorates and the Fed makes no move, that would be bad. But what has happened here is that now the Fed's been given a somewhat of a creaked open door. Does that, and do I like that? Do I even, I don't like that. I don't like that the market is so heavily dependent on what the Fed does. It's just ridiculous, but it is. We can't ignore it. So now that we have a first read could get revised, the revisions are 30% oftentimes. So we have this GDP read at 1.6%. Whoa, does that mean that things are slowing down and now the Fed does it change the expectation of a rate cut? A rate cut could change everything again, right? But the likelihood that happens when is it the Fed meets? It's coming up.
Next Tuesday or Wednesday, I think.
Yeah. Next Tuesday, Wednesday. Are they going to do anything? Doubtful, right? No. June, doubtful. But if there are additional, Barry, I agree. Barry Norton, it's probably not going to do anything. So that then means to me that we could get mired in a bad period in the market. There's weak demand, high supply. I don't know. We'll see.
Yeah, I mean, the only thing I would say is, I mean, I looked at the data. Anytime we got down to 2 and have come back up. I mean, there's one time, which was 2020, where we went right back down to 2, and you gained at least somewhere between 1 to 5% when we touched 2. So
Yep.
I mean, it's
Yeah.
I thought today buying at that GDP like that, you might not get an opportunity like that. We might go back up to those highs fast, right?
Absolutely could. Absolutely
Microsoft comes in hot today and PC's down a little bit, like we're off to the races, in my opinion.
It could very well happen. I don't disagree.
Mhm.
Yeah, we'll see. I did, when that happened in March 2020, when broad sentiment dropped below 1 the first time, I plowed hundreds of thousands of dollars into equities, and then it went down again. We had the double dip, and I thought, wow, maybe I did that wrong, but it all worked out. It's so you're right. It could very well happen that those demand reads are far more accurate than our hunches and assumptions, because they reflect everybody's hunches and assumptions. Yeah.
I mean, I'm going through the data right now. It's crazy. And then there are periods where like it didn't touch below 4 after that for like 10 months.
Exactly. Yep. Yeah, Steve, please.
I just, since we're kind of finishing up, I wanted to give you my weekly report.
Oh, good. And Nate's run your data too. And it looked good. I'm asked him to do a bit more, but yes.
Well, by buying at the recommended entry point and selling a low volatility at 1% and up or down, either way, you have a 1% rise or fall. I'm using the stop limit, which I know you just said don't do, but
you have to at times. There's no choice, right? Yeah.
But using that, and then 2% on the momentum, and the same thing there. I give myself a little more breadth on the stop limit.
Okay.
What I'm actually doing is I'm going in and buying a bracket of 2% on the momentum and 1% on the low volatility stocks. And after 21 trading days, I'm up 8%. And that's through this whole entire drop that we've had.
That is good. That is very good.
That plays out to be 97% for the year.
Well, let's hope it plays out that way.
I'm more concerned of when we get into less volatility, because then you don't get the drops down to the low entry when you have smaller, if the market's going straight up. I think the good
part is we're back to the 70s. You're going to see volatility for a long time.
I
agree with you, John.
I hope so too. I hope you're right. But to us, the diminished volatility is a big warning sign, because in the same way it gets harder for us to produce returns, it gets harder for all the market neutral folks. Those are trillions of dollars. It gets harder for the high frequency traders. Nobody can figure out which side of the trade to be on, and so everybody stops and the market collapses. It takes a big hit. It's been highly correlated. When we when we see the expected 1% volatility in SPY drop to half that, we know we're in trouble. And it happened right ahead of this drop. It dropped to 40 basis points at one point. Yeah, not good for any of us. Yeah.
Hey Tim, I have a question for you.
Yeah, Barry.
TradeStation, the brokerage, used to have the ability to route your orders directly to the exchanges, so you could eliminate them going through any intermediaries. Would that be a way of using stops and so forth and not getting stopped out because these people in between would not see it, or are the exchanges just as guilty of doing that, looking at what's there and trying to stop people out?
To me, they're worse. They're the ones paying the predators to set bids and offers. So if you talk to the sophisticated institutions, they say the last place I go is the exchange. I would actually rather route my trade to a dark pool because I have a better chance of getting the midpoint price than send it to an exchange. All my bad trades execute at the exchanges.
Does Interactive Brokers give you the ability to route to who you want, so you could route to one of the market makers? And
you can. You have to pay commissions, but yeah, absolutely you can. I think non-directed orders are free. Directed orders, you got to pay a little commission, but it's not much.
I mean,
Yeah.
they'll execute. I bet you half my orders are executed by IB themselves, and they're at the mid of the bid. Right?
Yep. Mine the same way, John. Half my trades are my own broker taking the
John,
other side.
who's your brokerage, John? Just curious.
Interactive brokers. They're probably
Okay.
the best, I would say, for the retail guys.
Gotcha.
Very powerful platform. You know, Tom Petterfee invented electronic trading. He
Yeah.
sold Timber Hill to Citi, and that became the electronic engine that became the standard. Yeah.
I used to stand next to those guys on the floor.
There you go.
That's where they started Timber Hill. They were options traders, and
Yep.
they flipped it out.
Yep.
Yeah, the only thing I see with interactive brokers is their platform is definitely behind like TD Ameritrade or any of the folks with Thinkorswim or even TradeStation or any of the other platforms.
They just rolled out a new web app, though. You might want to go check. I agree with you. TWS is, it definitely looks like it did in the 90s, but
it's too much
what?
information for me, but
It still works. Like, they have the best fills and everything. Like, they're good for a bunch of stuff like bonds. They have the best margin. You're getting like 4.85, I think, on our cash right now, Tim, right? Like, it's a good, I mean, you look past that part, it's a good platform. Their mobile app is very good.
Yeah. Amex is only paying us 4.25 now for cash. So my brokerage pays us more than where we put our emergency funds.
Yeah,
that's kind of crazy.
That's what you get with them. I mean, it is killer that they're offering that much. It's awesome.
Yeah. All right. Good. Go ahead, John. Sorry,
I was just saying. I mean, if you really want to get funky and do futures, you get paid cash on your cash balance, and you can basically get levered to what your returns are. If you just want to mirror the SPX fund BS. So
interesting. That's good. All right, you guys. Very good to see you all. Thank you very much. See you next week.